Excellent. Well, thank you all very, very much for joining us this afternoon. Good afternoon. My name is Scott Hodge, if I don't know you or if you don't know me. I'm president of the Tax Foundation, and I'd like to welcome all of you to our Talking Tax Reform program on creating a modern tax code for modern families. And for those of you watching at home or on our internet stream this afternoon, we are coming live from the Rayburn House office building here right across from the U.S. Capitol. Pretty cool place to be. I especially want to extend a special thanks to our partners at Intuit's Tax and Financial Center, who are sponsoring this program and who have worked so hard to put all the arrangements together. Thank you all very much for that. This is the second, actually, of our Talking Tax Reform series of programs that the Tax Foundation and the Tax and Financial Center will host over the next few months to raise the level of informed debate over tax reform. And from what I'm being told, today is the official start of tax reform season. We were supposed to be, I think, debating health care at this point, but someone's decided that, well, we'll move on to tax reform because it's supposedly easier. Aha! They don't know anything about tax reform, if they're saying that. Well, nonetheless, this is a great time to begin talking about some of the more challenging issues in tax reform. And family tax policy is one of those. Today's families bear no resemblance to the nuclear families that most of us grew up with, like Leave It to Beaver and even The Cosby Show. Today's families look a lot more like families on, well, Modern Family or even Blackish, with multiple generations, second marriages, and even same-sex marriages. But you can't say that we haven't tried to use the tax code to help families over the last couple years. I mean, if you look just over the past 2 decades alone, lawmakers have increasingly tried to use the tax code to deliver all kinds of social and economic services, such as helping people buy hybrid vehicles, purchase health insurance, buy a home, replace the home's windows, adopt children, put them in daycare, purchase their school supplies, then pay for their college, then take care of grandma, and the list goes on and on. And not only has all of that tax engineering made the tax code a nightmare for families to comply with, but it's made the IRS sort of an extension of, or in some cases a replacement, for a lot of cabinet agencies, everything from energy to education to HHS and housing and urban development. And so it's no wonder that the IRS is struggling to itself to administer this tax system. So the question for all of us is, can we create a simpler tax system for today's modern families? And can we do it in a way that's fair and equitable? Well, we have a wonderful panel of experts to answer these questions for us this afternoon. Starting with Elaine Maag, who's Senior Research Associate at the Urban Institute. My colleague Kyle Pomerleau, Director of Federal Projects at the Tax Foundation. Nina Olson, who many of you may know, the Taxpayer Advocate at the IRS. And Pete Sepp, President of the National Taxpayers Union. And we'll start with Elaine, who will discuss the results of a forthcoming study that she's written with a colleague on the tax code's effects on today's middle-class families. Kyle will then give us an overview of the kind of family-related policies that are being designed and discussed on Capitol Hill and actually at the White House as well. Nina will then talk about the findings for a latest Taxpayer Advocate report to Congress about the serious complexity facing today's families. And then Pete will back cleanup and dive into the cost of compliance on today's families, as well as providing us some cautionary notes on filing and privacy issues. Fantastic panel. And if you're on your Twitter machine and you have questions, comments, or if you'd like to live tweet, please use #TalkingTax as your reference. So without further ado, we will move on to #TalkingTax with Elaine Maag. Elaine.
Thank you. And thanks to the Tax Foundation and Intuit for hosting this series and inviting me to speak. It's always a real honor to be up here on Capitol Hill to talk with people who are actually making policy and to see that there's concern for how families are affected by the tax code warms my heart, as it's what I spend all of my time thinking about these days. The timing, of course, couldn't be better, as tax reform is going to get its moment in the sun. And to that, I wish everyone in the room good luck. We are ready at the Tax Policy Center to provide analysis, hopefully in a timely fashion, that provides you the information you need. The work I'm talking about today was performed with my Urban Institute colleague, Liz Peters and Carrie Liu, as well as analysts at the U.S. Financial Diaries Project, Anthony Hannigan, Tim Ogden, and Julie Sawicki. So the point of the study that we did is that taxes are hard for everybody. They involve organization, math, laws, and it's enough to intimidate everybody. But I'd like to make a case that a changing economy and less stable family structures have combined to make taxes particularly hard. And they represent a growing wedge between what tax law thinks people look like and what they actually look like. And so I'd like to talk about how incomes have evolved along with family structure to make complying with tax laws very difficult for some families. And I think this statistic that I want people to walk away with today is that our half of all working age adults and 64% of low income working age adults live in a household where in at least 1 month of the year, their income will spike or dip at least 25% over their monthly average. So if you have in your mind a worker like myself who earns roughly the same every single month, I'm almost in the minority anymore. So people have many streams of income coming in. They have different people contributing to the household income at different points in the year. And that volatility can make taxes difficult. So there's been a growing interest in income volatility in general that family experiences over the course of the year. The question is, month by month, how much is income changing? And analysts have started to describe how this affects financial security. But people concerned with taxes ought to be concerned with income volatility as well. Namely, income volatility makes filing a tax return correctly difficult. And for low-income families, income volatility may make it extremely difficult to predict or understand the largest financial transaction that they may have each year, which is their tax refund. So it's worth noting that annually the Earned Income Tax Credit and the Child Tax Credit lift more working-age people out of poverty than any other federal government program, more than SNAP, more than TANF, and that's according to the Census Bureau. And research shows that families understand that they receive these tax credits because they work. But families can be in for quite a shock when they receive a credit 1 year and they're counseled on the fact that they received that credit because they worked. But then income volatility sets in. And as income volatility rises, it becomes more and more difficult to predict what next year's credit will be or won't be. So in 2017, a family with 2 children needed to earn between $14,000 and $18,000 to qualify for the maximum earned income tax credit, and that's roughly full-time, full-year work in many states. So most of these families would also qualify for a child tax credit, which would add up to probably around $1,500. If a parent with 2 children living at home held a steady job over the course of the year, which would earn them about $1,500 each month, they could expect to receive an EITC that's worth $5,600. So this is a substantial share of total income. But all that can change if she's unemployed half the year. Not only will her wages drop in half, she'll lose $2,000 in her earned income tax credit, and she'll lose another $1,000 in her child tax credit. So if a family is counting on that income, not having it will be a huge blow. And things can even go awry when your financial situation improves. Imagine that instead of losing her job, instead of earning $1,500 a month, her income goes up by 50% a year. Well, she's going to lose $1,800 in her earned income tax credit. So that offsets about 20% of those new earnings. So these are big and real changes for low-income families. So my colleagues and I used data from the Survey of Income and Program Participation, and we looked at the years 2008 to 2012. Those are the most recent years for which we have data. And my guess is the volatility I'm talking about has gotten a little bit worse or more prominent in the years after that survey. So we looked at to the extent at which an adult's income spiked up or dipped by at least 25% compared to their average monthly income. And because we're interested in how these spikes and dips interact with taxes, we focused only on taxable income, but our findings don't change when we look at all income, except that transfers do have a stabilizing stabilizing effect in households, as you would expect. So we found that living in a household where taxable income stays smooth throughout the year is becoming the exception. In the years we looked at, half of adults live in households where there is at least 1 month where there's a spike or dip. For low-income households, it's even more common. 64% of adults living in low-income households had at least 1 month where their income dipped by at least 25% or spiked. Moreover, almost a quarter of all households have at least 6 months where their income is spiking or dipping, which is true of almost 40% of low-income households. So that's 40% of people who are at twice poverty below. In 6 months of the year, they are seeing their income 25% above or below their average, making it extremely difficult to predict what their annual income will be. So why does this happen? We think about it in terms of 3 factors. There's sort of or 2 factors. There's sort of economic factors that are happening, and there's also demographic factors that are happening. And the demographic factors that we see are people are moving in and out of households. These are both children and adults, and that affects your income. And the economic factor, that is the big wild card, is self-employment income. So our key findings are that self-employment income can be a big wild card in household finance. Overall, about 20% of adults report living in households with at least some self-employment income, and those households experience many more spikes and dips than households without self-employment income. So 70% of adults living in a house with self-employment income experience an income dip or spike, compared to about 45% of households without self-employment income. So that self-employment income is stuff you hear about in the new gig economy. It's piecework. It's sometimes having a business for only a few months of the year. It's all sorts of things that are becoming more and more prominent in today's economy. So for low-income households, the numbers are even more stark. So 86% of low-income adults live in a household where if they have self-employment income, they can expect their income to shift at least 1 month by at least 25%. And 50% of them compared to about 50% that don't have self-employment. So, and importantly, 40% of all households and 60% of all of low-income households with self-employment have 6 months a year when their income is up or down, above or below that average income. And children matter too. So what we find is that in today's households, we have children that are moving in and out of households. They're doing this in perfectly reasonable ways. They have 2 parents that don't live together, so they might spend half a year with one parent, half a year with another. They might be moving week to week. There's all sorts of arrangements that are happening. And it seems to be from the data that for low-income households, when a child enters, it's actually a stabilizing force. So it might be that adults are there as well, and once you have the pressure of a child in the household, you are driven to keep that income steady, but children do have a stabilizing effect. But the opposite is true for adults. So adults are moving in and out of households also, just like they're becoming divorced and married, and they're cohabiting, they're coming in and out of the households, and this causes income to spike or dip. So sometimes they come with their own jobs, and that causes a spike, so it can be a real stabilizing force for a household. But sometimes they come with intense needs. So you can think of this as an adult parent who comes into the household who has caregiving needs, and it can throw a wrench into someone's work schedule. So when adults are moving in and out of the households, which is more and more common, we actually see more income spiking and dipping. So for households where an adult changed, 80% of all adults and 84% of low-income adults were living in a house where income spiked or dipped. So it's almost ubiquitous. If a person comes in or out of your household that's an adult, your income is going to radically change, and this affects how much you're going to owe in taxes at the end of the year. So this, in the end, presents a tremendous challenge to tax reformers. We know from work we did last year that marriage is no longer the norm for low-income families. More than half of children live in a household that's not headed by their 2 married parents. From this work, we find out that not only are family structures evolving, but income composition evolves with those family structure changes. And that changing income, we know, can have a big effect on taxes. So in order to accurately file a tax return, return. Individuals and couples must report their annual income. People who live in households with highly volatile income likely have multiple income sources, inconsistent income sources, or changes in who is even contributing to household income. And all of these situations complicate figuring out whose income belongs on that tax return. Second, receipt of the EITC, again, the single largest anti-poverty program for working age people in the United States, is dependent on the number of children that are in your tax unit, as well as the earnings in that tax unit. And as reported in previous work, complexity in households may make it difficult to understand what tax credits a person will qualify for. And equally vexing can be predicting income for households that experience these large month-over-month income swings. So if people are unable to accurately predict who's in their household, or unable to accurately predict their annual income because their monthly income is varying, they may guess incorrectly at the tax refund they'll receive. And in some cases, the EITC will be larger than anticipated, a situation that could be welcome. But in other cases, a family might anticipate receiving a large credit and instead receive a radically smaller credit. This missed income could be difficult for a family to deal with and compile on to an already complex financial situation. So the challenge for tax reformers, of course, is figuring out how can the IRS effectively recognize the complications that come with income volatility and how they play out in taxes owed. And so I would beg people, when you're thinking about tax reform, if you're going to think about how you tax working families and you're going to provide substantial benefits to the tax code, you try and step back and think about what do these families actually look like and how can we make it so these programs can have their biggest impact on people by making it easy for them to predict what are the tax benefits going to be and how can we make them the most stable possible.
Thank you very much, Elaine. That was terrific. Kyle?
Yep.
What's happening on Capitol Hill right now?
Yeah, thanks, Scott. Yeah, so I was asked just to talk about family tax policy and how it fits into tax reform generally. And clearly, I think there's a lot of space to reform and fix child tax policy. And I know on the Hill there's a lot of interest in different proposals to either reform it or expand child policy or family policy in the tax code. And it could be part of tax reform or it could not. But what I want to talk about just is I want to make three general points about, thinking about family tax policy in the context of tax reform. So the first point I want to make is that, fixing some of these benefits is probably worthwhile, but in the context of tax reform, they likely will come at the expense of other priorities. So let's just look at the tax reform proposal that's out there right now, the House GOP plan. Right now, I think the big focus of that plan is to increase the economic efficiency of the tax code. So it brings marginal rates way down for investment, brings them down for working, but then at the same time broadens the tax base. An economist would tell you that's great. But it doesn't do very much on the family and child policy front. I mean, it does some small things. It converts the personal exemption into a non-child dependent credit, expands the CTC a little bit, but that's a relatively small proposal that basically shifts the burden around rather than really reforms anything big. So right now, a lot of what the base broadeners are going to is to reduce those marginal tax rates. And the marginal tax rates in the plan actually are so low to the point that they reduce revenue overall. So the base is broader, but the rates come down even more. And it gets close to revenue neutral when you start thinking about dynamic scoring, but it's not clear that you're actually be able to make, quote, pay for the reduction in revenue that's built into the plan. So adding in additional child benefits would likely come at the expense of some of the rate reductions or other reforms that are already built into the tax plan as is. For example, if you were to take a tax policy that reduces revenue by about $300 billion, I think you would have to make that up on top of what you already have to make up in terms of the tax cut that's built into the reform. The second point general point I want to make is that the structure of your proposal matters a great deal to who benefits from the policy and how much revenue it ends up losing as part of your tax reform proposal. We can take some examples of past reform proposals to show how these trade-offs play out. The first one, which is the Rubio-Lee credit proposal that was put forth in the campaign. So if we remember, this one basically creates a new child tax credit of $2,500 for each child. And what it's meant to do is reduce or offset payroll tax liability. So it's refundable up to the portion of payroll tax liability. Now, because it's offsetting payroll tax liability, well, payroll tax raises a bunch of revenue. This ends up reducing revenue a lot and ends up being a large tax cut. So it's doing what it's supposed to. It's providing additional benefits for families with children by offsetting their payroll tax, but it ends up reducing revenue by about $1.3 trillion over a decade. So there's a big trade-off there that you're giving a broad tax cut to people, but reducing revenue significantly. Another proposal that may be more targeted, if you look at the Clinton campaign proposal, she also proposed expanding the child tax credit, but only for very low-income families. And this one ended up cutting taxes or increasing refunds for those at the low end, but only costing about $210 billion over a decade, simply because it's very well targeted to a specific group. So you can see a very distinct trade-off there. And there's also another structure component to pay attention to, is the difference between credits and deductions and how that interacts to benefit different taxpayers. Credits, of course, are much better for those that are facing lower marginal tax rates or lower income families. Deductions, of course, get more generous as your marginal rate goes up. So you can see as a deduction would be more tilted to the high end, a credit would be more tilted to either the middle or lower income taxpayers. And you can see this looking at Trump's campaign proposal, that he put forth a proposal that allowed families to deduct child care expenses or exclude child care expenses from AGI. And of course, if you have a high margin, if you're facing a high marginal tax rate and actually have AGI or taxable income, you benefit. But if you are significantly low income, you wouldn't benefit from that proposal. Most of the other proposals, of course, are structured as credits, so they end up benefiting lower income taxpayers. And the last point I want to make about family tax policy and tax reform is that if you want to address this or address family tax policy or expand the role of the tax code in family tax policy, and this is going to reduce revenue, you have to take base broadeners very seriously in your tax reform. Otherwise, you're going to have to give up on a significant number of other priorities. The House GOP blueprint, of course, if you take all of the base broadeners, it's about $5 trillion in base broadeners over a decade in order to significantly lower marginal tax rate. That includes, on the business side, the border adjustment, the elimination of the interest expense deduction, but also on the individual side, there's elimination of a few credits, but also elimination of the state and local tax deduction. In order to pay for rate reductions, those are in there. But I mean, if you take out those base broadeners, you're even farther away from being able to make your family tax policy feasible in any way. So that's very important to consider, that if tax reform loses some of those base broadeners, the ability to do other things that lawmakers may find important becomes much less likely. So.
Thank you very much, Kyle. And Nina, what are you telling members of Congress?
Well, first, to start out with, the perspective that I bring to the issue of what I call family status taxation is that of a person who has represented many families, prepared many income tax returns for the first 22 years of my professional life, and then for the last 16 years having been the national taxpayer advocate, so having watched taxpayers struggling with complying with the laws, but also watching the IRS struggle with complying with the structure of the laws and administering it. And so what I did this year in my annual report to Congress, in addition to recommending that we have tax simplification now, and we have a whole legislative recommendation that lays out a lot of information about the burden on taxpayers, including that taxpayers, businesses and individuals have to spend 6.1 billion hours a year meeting their annual filing requirements. So just think about that for a minute. But that I My second legislative recommendation was for simplification of the family status provisions in the Internal Revenue Code. And I worked a lot off of Elaine's research and her colleagues' research from last year, looking at what was happening with family structure in the United States from the 2000s up into, from the 1990s up until the 2000s. And I really tried to make recommendations that would be administrable by the IRS, but would not catch taxpayers into all sorts of traps for the unwary. And it is my proposals are actually very pragmatic, and they're based on IRS data, and they're based on my observation of taxpayer behavior, because I'm a firm believer in conforming the tax code to the way people live their lives. And we do have a very great disconnect, particularly in the family status area. The other benefit that I had is that I have met with tax administrators around the world and have been able to look at what United Kingdom, Australia, Canada, and several other countries have done actually and how they're dealing with the family. So I thought I would just walk through the recommendations, and then for those of you have an executive summary, but if you want to read more in my 700-page annual report to Congress, you can get that from taxpayeradvocate.irs.gov. But really the proposal, there's lots of really good information in there. So the first thing, as Elaine's work really shows, but the IRS knows that 1/3 of the earned income tax credit population churns each year. A third of the taxpayers are new to the EITC, and a third, they move out. So they're moving back and forth and back and forth. And when you think about something as complex as the earned income tax credit, much less dependency exemptions, et cetera, there's a steep learning curve. And if your situations change every single year, you're not going to know why you are no longer eligible for this credit. And so it also makes you susceptible to anybody telling you, have I got a deal for you? And that's another thing that you see, that this very vulnerable population is susceptible to preparers who have no oversight whatsoever and can basically sell you a bill of goods. And since it all seems pretty irrational, why not believe it? The EITC itself is subject to high improper payment rates. The estimates are between 27 and 32% of the claims paid out are incorrect. And the IRS has done a lot of research into what the sources of those improper claims are, and I analyze them in my annual report out that data. I do want to say that I view the EITC as a very successful program. It was designed to run through the Internal Revenue Code to avoid the negative stigma of people having to go into an office and be interviewed by a welfare caseworker, which you have low participation rates in many of those types of programs. The EITC enjoys very high participation rates. And on page 341 of my annual report, you will see a chart that compares EITC administrative costs, overclaim, error rates and participation rates with the other major federal benefits programs. And when you look at the whole program, you will see that the overall costs, administration and errors, puts the EITC smack in the middle of other benefits programs when you look at them together. But then the participation rate puts it among the top most effective poverty programs or anti-poverty programs in the United States. And I think that point is often lost in our discussions. So what did I try to do? So what I have suggested is that we have in the Internal Revenue Code 6 family status provisions. The dependency exemption, the personal exemption, head of household status, plus your other filing statuses, the earned income tax credit, the child tax credit, the child and dependent care credit, and a provision that I count as a family status one, which is your definition of being married. If you're separated under a legal decree of separation, but you're not divorced by the end of the year, you have a choice: married filing separately, married filing jointly, or maybe you qualify for head of household. And maybe you all can pass the test for what the rules are about that. But I spent a day and a half writing the legal description of those provisions for the present law. And by the end of that day and a half, I just wanted to hit my head on the table. It was just so complex. And I have a JD and a Master's of Law in Taxation, so that should tell you something. So what I did was I took all those credits, and I didn't do any numbers on this in terms of what it would cost, because I was thinking there's a pool of money here in all of these credits. So let's just leave, for now, that pool of money what it is. Just put it all in a big pot. What I would do is divide all those different provisions into 2 credits. One is a family credit, and one is an earned income credit. With the earned income credit, I would make it per person. What we know about the earned income credit today is that the most numerous errors that taxpayers face in the create in the earned income credit is misreporting of income. Well, thanks to Congress, this filing season, IRS now has all W-2s and all 1099 miscellaneous self-employment income by January 31st. And the Congress also passed a law saying you will not issue a refund on earned income credit until February 15th. So we had pretty much 85% of all the W-2s and all of the 1099 miscellaneous, self-employment income in our database before we issued any EITC refunds this year. And so if you make the earned income credit a per person going toward low income earners per person, we will be able to eliminate most of the errors in that environment. It will be virtually error-free. Now, you're always going to have some cash economy, and so we'll have to do some audits to track that. But you've just literally eliminated a whole bunch of errors in the EITC by focusing solely on, focusing that credit, the earned income. And it would be refundable for low-income workers, and you can decide where you want to do that. Now, part of my proposal is you expand that to 18-year-olds and people over 65. And we have the numbers in our report to show how many workers there are, single workers there are, 18 and above. We seem to think that everybody's going to college, and I'm here to tell you they're not. And so you need to expand that. And also we have the information about the people who are working over 65. And I would retain the part of the EITC that measures your investment income. So if you get too much investment income, you would be ineligible for the EITC, and that goes for the people over 65 who are just working because they're bored, but they have significant assets and they're getting investment income from that. So you're really targeting it to the working poor. So that takes care of that component. And then you have the family credit. And there I really work on Elaine's data. And I won't go through all of the provisions that I do, but I would create a credit rather than a dependency exemption because I believe credits are more fair and equitably distributed. And at the lower income level, I would make it refundable for the low income, and that would be based on family. And I expand the definition of family to reflect the fact that we have households with no biological parent, that people move back and forth and back and forth. I also I suggest that we eliminate the phase out. If we think that whatever the number is, $3,000, $4,000, whatever it is, that you want to give a credit for the cost of raising a kid in the United States, that should be the cost of raising a kid regardless of what your living, your income level is. So there's my SOP to the very wealthy. Then I go to the non-custodial parents of America, because I also think that we should recognize that non-custodial parents have costs, and it is actually a public policy that we should want to encourage them to incur costs for their children. Right? So maybe do a non-custodial parent credit that's an add-on to this basic family credit, your personal credit, and then a credit for your custodial children. But then recognize if a person has paid substantially all of their child support obligation, why not give them a credit? They are incurring costs. They have less ability to pay to go for that child. And the tax code should recognize that lower ability to pay. So that's another recommendation. I also, just to sort of wrap this up, I I also redefine what it means to be married and not married. There's this provision in the code that says you're considered not married if you're divorced by the end of the year or you have a decree of separate maintenance. Now, I first got my law degree in North Carolina, and it's one of the few states that still has a decree of separate maintenance, otherwise known as bed and board divorces, and that's why when I studied for the law bar exam decades ago, I still remember it. But there are very few states that have that. And what we're not recognizing is the era of no-fault divorce and things like that. And so I say, if you have a binding separation agreement by the end of the year, you should be you should be considered not divorced unless, why do I care? I don't want to get into inquiries about this. And the tax agency, for God's sake, you don't want us thinking about this stuff. So that's sort of really the point of what I'm proposing, is to get try to find easier ways for the IRS to look at existing data and really determine, where does the child live for most of the year? Do we really care about all these relationship stuff as long as we know the child exists, that only one person is claiming this child, and, people can work it out among themselves who should claim the child. Now, just to make sure that the IRS gets some attention here, I have said that the IRS should be required to maintain a toll-free phone number around the year, staffed by live human beings, not a machine, to answer tax law questions from taxpayers who have questions about their family, how they should be filing their return, et cetera. Because this is such a complex area, and every time a taxpayer calls us is an opportunity for us to educate them. And also, since so many of these taxpayers are going to unregulated return preparers, people who are not attorneys, not CPAs, not enrolled agents, that if they could call us and say, my preparer promised me the moon, that would give us an opportunity to really educate them so that they would understand the rules.
Very good. Well, thank you very much. And Pete, what's the compliance cost of all this?
Astronomical.
Okay. Case closed.
You want
Any
a real
questions?
number?
Any questions?
Okay. To put this figure into perspective of 6.1 billion hours spent complying with the tax system, we have actually quantified this using Department of Labor figures on average hourly compensation. It comes out to $234 billion a year spent just attempting to comply with the business and personal income tax. The problem is the status quo, thinking that, well, if we don't do tax reform this year, it'll just be that bad. No, the status quo is not the static quo. It's going to get worse. The paperwork burden inventory at the Office of Management and Budget related to Treasury is expected to rise by another 2 billion hours in the next few years. 1/3 added to that. We're looking at a tax compliance cost of north of $400 billion a year. Can you imagine if any kind of simplification effort could shave a quarter of that burden off? $100 billion worth of productivity value put back into our economy. And this is the important point right now. It's an especially important one in this current post-Obamacare repeal environment. We now have about $1 trillion of baseline problem now that we didn't think we would have before, assuming Obamacare was going to be repealed. That's going to make tax reform a much tougher task. It also means we're going to have to find other ways of making every single simplification measure count, more so than it ever would have needed to count in the past. How do we do that? How do we use tax simplification not only to make lives better for families, but to also add value to the economy and productivity to the economy? Well, I think there are a few places to start. All the panelists here have excellent ideas in terms of making the tax code easier to understand, more in tune with the current family structure. But there are also 30,000-foot things we need to be thinking about in tax reform that will have an impact not only on businesses but also on families. One of them is reestablishing processes for simplification that will endure the test of time. One of Nina Olson's recommendations that I have been continually harping on and agree with wholeheartedly is we've got to re-involve the IRS in the tax simplification process by requiring the service to produce an annual report on sources of complexity in the tax code. This was required in the 1998 IRS Restructuring and Reform Act. IRS was supposed to do it every year. They've done it twice since then. This report is sort of part of a three-part process. Congress is supposed to issue tax complexity analyses to legislation. That was another requirement of the law in 1998. Unfortunately, there has to be a significant number of taxpayers affected by the law, and the analysis can only be accompanied in conference reports on tax bills. The bottom line is very few tax complexity analyses are ever conducted. I searched the previous Congress, all of the tax legislation, for one using the term tax complexity analysis. Couldn't find a single one conducted in any of the bills issued by Congress. This process of the IRS issuing an annual report is supposed to complement the tax complexity analyses. It was built in to the IRS Restructuring and Reform Act, along with requiring frontline IRS personnel to consult with Congress on the development of future tax laws. They were all supposed to work together. One part of this is missing, so the whole of it is failing. It is failing to encourage tax simplification. Another recommendation that the Commission on Restructuring the IRS made, pursuant to the legislation, was that we have a quadrennial simplification process. Every 4 years, we get together members of the tax advice community, the IRS itself, staff, all of them getting together to go through the tax code, if not line by line, then perhaps take a number of sections and simply review them for their administrability, make recommendations, subject those recommendations to a BRAC-like process, an up or down vote. That can help to clean out the tax code and have a direct impact upon families. Establishing these processes and making tax simplification habitual rather than haphazard will be vital to the success of any future tax reform bill. We also need to confront the fact that the Internal Revenue Service Oversight Board, established in the Restructuring and Reform Act, has not been functional for the better part of 2 years now. This board was meant to oversee the business operations, the managerial operations, the overall progress of the strategic plan of the IRS, and yet the Senate and the White House, both in the previous administration and even administrations prior, have consistently fought over the nominees and delayed the nominations. The IRS Oversight Board is not working right now. Congress either needs to put nominees in place, that's a Senate job. The White House needs to bring forth nominees, and if neither of these two entities is going to fulfill their responsibility, then we have to reconsider some other kind of oversight entity to make the rest of the law work. There are other smaller but equally important things we need to do. One of the pieces of legislation that my organization has endorsed, and there was a piece of paper on it when you came in, is the Free File Act. That's H.R. 4938 in the previous Congress. What that does is make the Free File Alliance program permanent. How does that help families? Well, it's a public-private partnership that allows about 70% of all taxpayers to utilize one of about a dozen services to file their tax returns online for free, hence the name. This has been remarkably successful because it doesn't really cost the IRS a dime. This is being borne by the private sector to enable electronic filing. It saved upwards of $100 million in government paperwork and other processing costs that it would have normally incurred without the existence of the program. That is a win-win for taxpayers and the government. They're getting good service at a price the government doesn't have to bear. That's especially important at a time like this when we're still dealing with questions of how much more can we increase the IRS's budget, if at all. Major bonus. Ultimately, though, we need to be concerned about the IRS's ability to handle everyday taxpayer concerns. Nina Olson is right about having much higher taxpayer service standards, including a real live person, a single person who might actually be assigned on the other end of the phone to handle an individual taxpayer's concerns. That's a major anxiety point for families, that when they do have a question or a problem with the IRS, they don't know who to contact. These are important considerations too, and ultimately, we need to remember here that if we move forward with tax reform, for example, the House's blueprint to allow a postcard-sized tax filing process, privacy and process are just as important as the tagline, "Oh boy, we can file our returns on a postcard." What if, for example, as we've seen with controversies in the past over the IRS having access to taxpayers' email correspondence with advisors, what if the postcard-size form resides on the IRS's website and suddenly taxpayers' keystrokes can be monitored? Things they put in for income but later erase are tracked by the agency, which might be able to say, hey, wait a minute, what if this person, in erasing their initial entry, is hiding income? That sounds paranoid. It isn't. It's actually a central issue for a number of years, decades, of the privacy of communications between clients and tax advisors. It's the same type of issue. So when we're designing these kinds of simplification measures, we have to bear in mind that the IRS's track record on automation, on privacy, on information security has not been all that great. And if we're going to do this right, if we're going to give families the confidence in the tax system, the ease of compliance, we're going to have to think about these details well beyond defining rates and the tax base. I'm through.
Well, thank you very much, Pete, and thanks to all of you. And I want to get to your questions. Hopefully I can see around the podium here. But let me start off with to Elaine and Nina. Getting a couple of questions arise when it comes to the ITC. One is obviously the compliance issue that Pete mentioned. I think one report of yours, Nina, had 76% of people who take the ITC have to pay or do pay someone to help them with their form. And I've looked, if you've ever wanted to face a nightmare, get the EITC booklet. It's like 96 pages long and a scary document if there ever was one. So how do you get over that, where you have this benefit, you're trying to help people, but they've got to pay someone else to help them do that? Secondly, you've got issues with the phase-outs and people facing marginal effective tax rates as it's phasing out, and then you've got the disincentive effect of that. My goodness, how do you deal with that and then not just have cliffs that have their own problems where the benefit stops at a certain income level, and then people face this huge cliff in their effective tax rate? I don't know who wants to start with that one.
Well, the design elements are really difficult, and I think, in my opinion, the current structure where you have it slowly increasing and then you reach the plateau and then it slowly decreases, so you don't have a cliff, but you do have that plateau, is about the best that you can do. And I also think that some of the, you have other benefits that might mitigate some of the cliffs or increase some of the cliffs. So if you're looking at my dual, let's split all these provisions in half, you have to be very, very conscious of the interaction between them, and if you're not exacerbating stuff that already exists. So I'm not trying to avoid it, but I haven't sat down and tried to design it in that way. I have to say that what I've tried to do, again, is really look at how people are living their lives and try to make the proposal something that would make sense to individual taxpayers as they're looking at their tax return. And they can't do that today. The earned income credit, when you see interviews with people who've received the earned income credit, they have no idea why they've received it. They don't know what they did that made them get it this year versus having it reduced the next year or having it jump up, like you're saying, the year after. Is it the child? Is it the money? Is it that you were unemployed half the year? They really don't know. And I think that lack of...
How can that provide an incentive?
Where's
when
the incentive
no
on that?
Linkage
Exactly. Exactly.
Yeah.
And I would just add that, so we are concerned about marginal tax rates as people, lose benefits. And we know that moving from poverty to twice poverty is extremely difficult, even if you just participate in a couple programs. So you basically can double your income and not be any better off. And that's because you're losing benefits on the Medicaid side, you're losing benefits in the SNAP program, you're losing benefits in the EITC. So all these things are important. You could design the work piece like the child piece that Nina proposes that doesn't phase out. And that sort of does two things. It gets rid of that marginal tax rate that you're worried about on the phase out. It also enables the way for you to be able to give the credit as advanceable because almost everyone would qualify for it and they wouldn't have to worry about it going away. And you can make up that revenue. It's of course extremely expensive. You can make that up by having a transparent higher rate that you apply to all income or at high incomes, however you want to pay for it. So you could do that. And then the last thing I would say, when people do studies of the EITC and work disincentive, we don't see it that much. There's a huge incentive for people to enter the labor market. There's a huge incentive for people to increase hours, but we don't see them drop their hours too much. We think that partly it's difficult for people to do that.
We do have a microphone, so if you have a question, just raise your hand, and we have a microphone over here. And Carol Merrill.
I have a question.
Oh, you have a question?
I do. I'm not passing this around yet.
Oh, you are not.
First of all, thank you all for some really insightful comments. It was clear and succinct analysis from each of you that was actually really interesting. I wanted to explore something that I think we started to get to in the last question, which is this notion of transparency to the taxpayer. We have this code that seems to have myriads of provisions that are aimed at triggering various kinds of behaviors, whether it's work or subsidizing various activities, but they only work if the person, in general, the person who's eligible for them can actually understand and see them. And so I wonder if, as we think about tax simplification, whether that might not be one of the principles that should underlie what we end up with, something that actually means that even an economist would agree the incentives are apparent to the taxpayer, and therefore you might actually get the results you're trying to get.
Yeah, I would just quickly say that this is a major concern of the taxpayer advocacy panels that have been created to hear taxpayers' concerns around the country, the designs of forms, the contents of the instructions, but plain English rewrites of all of the forms and instructions are going to be vital going forward. On the Senate side, Senator Warner has expressed some concerns and some interest in ordering the Government Accountability Office to do actually a plain English survey of tax forms and instructions. That'd be very valuable.
Yeah, there's a professor up at Carnegie, one of the Pennsylvania schools. He's an economic professor up there, has been doing some research using some program that measures the level of language within IRS forms and instruction booklets, and finds that they're written at a much higher level than what even your average newspaper, daily newspaper, would be written at. So it makes them very complicated for people who are, just trying to get by in life to actually comply with them.
If I can just, I think that to that point of, are these provisions actually doing what they are intended to do. I think that goes to the Restructuring Commission's recommendation about the quadrennial review, that you are actually looking at, is this provision that we enacted to have this result actually getting this result? The other thing that I would suggest is that as Congress is writing legislation, it really does need to have frontline IRS technical people. And I would suggest some of those people might be the forms and publications people on the staff of the IRS. As you have a provision, try to translate that into what that form is going to look like. Before you enact it, try to come up with a draft of the instructions before you enact it. Because when you see what you have to write to get it explained to taxpayers, it's just astonishing, and they will not get it right. They will not understand.
There's a question over here, sir.
Yes, sir. My name is Kami Bhatt. I'm with the Pakistani Spectator. And my question is, due to the fact that IRS doesn't have tremendous resources for auditing, and it has a lot of goodwill, I guess. So do we really need any major reform? Because as an ordinary taxpayer, I don't see it very complicated because I file by TurboTax. But a few years ago, I did lot of trading. It was more than $1 million, and I spent a lot of time with Fidelity Investment to understand it, but I couldn't get it. And I was hoping that IRS is going to audit me, but they never did. As a matter of fact, I expect every year, because I don't, even though I have degree in economics and then have an MBA, but I really, when I file it, I think if Turbo is not there, I wouldn't know ABC of tax filing.
So
but I was never called. So I think, what is the point of doing this? It seemed very complicated when I hear expert like you, but when we do on Turbo, it's not that difficult.
You've been looking over your shoulder for the last couple of years?
Yeah, I mean, I always expect
that
they would call me for auditing, but they never did it. So it means either they have a lot of goodwill and good faith in American.
That's a good question. Has software and all of that simplified things, even though it's more complicated, for those who are still doing it with pencil and paper? And
I actually, my personal opinion is, the software programs are wonderful, but I think they have enabled complexity. They have facilitated it, because you can say, well, the machines will work it out. All somebody has to do is, we're going to have questions, and then you plug in the answer. And so that has enabled people to add on more and more complexity on the legislative side, because the machines will work it. And I think that actually what that does overall, I just did a conference, we just held a conference, an international conference on taxpayer rights. And we had a panel on the impact of knowledge on tax compliance. And there is a lot of research out there that shows that as taxpayers have less and less knowledge about what is actually going on in their financial affairs, it has a negative effect on compliance, because they don't trust, they have more suspicion, and it just feels, particularly if you do get something wrong, arbitrary and capricious. And so I think all of those things militate, even though it may be easy for you, or you can use software and computationally it's easy. I think it's very difficult to design a software program that gets every single answer. And many of these returns that we get in for earned income credit are software prepared, or the preparers are using software. And you still get these high errors. So, I don't think that's a reason to not simplify.
There's also some things that the software just can't get at, and with respect to the family provisions, it's the question of whose return does this child belong on, and the software just can't determine that. You're supposed to figure out who the child lived with the majority of the year, and that's based on who they spent the most nights in the house with. Well, what if someone else provides more support? What if the couple breaks up halfway through the year? These are the kinds of questions that the software can't even get at. You're cohabiting, who gets the kid if you're not both biologically related, things like that still exist in the family arena.
Well, there are issues, too, as the legislators are trying to become more refined in who they're targeting benefits to. Children under 6, children under 17. Right. Well, none of that information is on a 1040, is it? Right. So how is anyone to be able to...
one of the data points that we came up with this year in the annual report to Congress, which is just... every year there's one that just gobsmacks me. And it's that for fiscal year 2016, Treasury estimated that the tax expenditures, the spending programs running through the Internal Revenue Code is $1.47 trillion for 2016. The entire direct discretionary spending budget for the entire federal government was $1.2 trillion. So we are running more spending programs through the Internal Revenue Code than we are in our discretionary direct spending budget. And that includes military. So when you think about that, that's where all the complexity is built in, that you've got this provision here for this group and this provision here for this group. We did something a few years ago, and this goes to software, where when Hurricane Katrina had hit and Congress enacted all sorts of provisions to benefit the victims of Hurricane Katrina. And in Free File, there were about 9 programs that incorporated those provisions into the software, but the rest of those programs did not. And there was nothing prompting the Katrina victim. They weren't asking, are you a victim of Katrina? So those benefits went unused. And when you think about that, it's like, well, now, how did that work? That we had benefits out there and they weren't claimed. And can you force people to program those things in? And we've got a whole point of free enterprise here. So it gets very, very complicated.
Well, I want to be mindful. One last question?
Questions for Kyle.
Oops, we need a microphone.
Among the pending proposals you see around family tax policy and simplification policy, which ones do you see have strong bipartisan support and which ones are more contentious?
I don't know if I can comment on that right now. I mean, I think it all depends on how they're going to be structured at the end of the day. 2 of these, of course, are campaign proposals. You can look at the Trump proposal. That one wasn't fully fleshed out in the campaign. I think there are still some questions about whether that one would work in practice. I think there are ones that could be structured in ways that could get some bipartisan support, but I'm not sure at this point which ones you could point to.
Well, perhaps we can have just a quick, I'm mindful of everyone's time, but we have congressional staff here and we have a pipeline to members, and so maybe a last wrap-up message from each of you on what you would tell members as they think about tax reform and how you can have a simple tax system for complex family matters.
So the tax system does 2 things. It collects money. It also sends money out, and it sends a tremendous amount of money out to very low-income families who are dependent on that assistance. It's the largest anti-poverty program. It's built into the tax system, and I think members of Congress need to be very mindful when the tax code gets opened of both of these functions that are happening so that we don't end up unwittingly taking away the support that people depend on.
I would just say, as you approach tax reform, too, as you think about corporate tax reform, do not forget about individual tax reform. I think we've shown the burden on folks in that way. And I think really understanding how people live their lives, not making them conform to some picture that is ideal, but rather understanding how they live their lives and conforming the code to that is really the point of view that will help the IRS, that will help taxpayers. It will reduce their burden.
This is a tremendous opportunity to restore confidence in the tax system and not only taxpayer rights, but remedies. By simplifying the system, by creating institutional processes to encourage simplification going forward, families are going to be helped, and we shouldn't overlook the fact that micro businesses, everything from the sharing economy to sole proprietorships, are going to be a way to upward mobility for millions more families. Making sure that the burden of compliance is simple for those types of businesses is key in any tax reform process.
2 points. So one, there's always trade-offs in tax reform. I think a good place to address some of the challenges with family tax policy or some of the fixes is a reform package, but you have to remember what you may be giving up at the same time. And the second point I want to make, and it's just based on what Pete said earlier, is that the failure to repeal and replace the ACA does not make tax reform $1 trillion more difficult. That number, of course, is not just the tax cuts that they failed to repeal, but also the coverage provisions in there. But it's also a point to be made that you do not need to repeal the ACA taxes as part of tax reform. That it's not really a baseline issue, and that I think that the challenge of tax reform is it's as challenging as it was going to be whether or not the ACA was repealed and replaced.
Well, I'd like to, let's all thank our panel for a wonderful presentation. I want to, just on behalf of the Tax Foundation and Intuit, I want you to stay tuned. We'll be planning a third of our series in the coming weeks on a topic to be determined. And I tell you what, the topics are only getting more interesting. And stay tuned for a great debate on tax reform. This is going to be a fascinating year for all of us tax nerds. This is what we've been waiting a lifetime for. So thank you and have a great afternoon.
Let's hope. We shall see.